Good morning. So this is 26th November 2025. We're recording after a few months. So we've been on some form of a break, but rest assured we should be doing this on a weekly basis. I'm going to try doing a Friday market recap, and if things go well, then we'll get back to also doing the lives on an alternative basis. One of the reasons why I wanted to make the video today was because I wanted to explain to people that there is a little bit of a conundrum that's currently going on with the entire AI story. And that is visible in some stocks, that is also visible within the economy. And while everybody is screaming that this is an AI bubble and you are going to be seeing prices go higher maybe for the next few years, you must be cognizant of the fact that at points of time, stocks that you own as well as the indexes in itself can pull back, and necessarily every pullback is not going to lead to a new all-time high. So few things that have been going on in the market is you will be seeing some of these AI companies, especially companies like Oracle that have taken on over $100 billion in debt. They are looking like their debt might be some form of a concern. Now you will see a chart come up on your screen eventually of the Oracle CDS, credit default swaps, which is basically, for anyone that doesn't know what it is, it's basically an insurance against the fact that if Oracle defaults, the lenders that were there, the credit default swap is some form of a protection for them. And you and I can make those trades as well to some extent, as well as most institutions do. It's never usually a concern. You don't even need to know what a credit default swap is. It's basically only a concern when you enter a stage where these credit default swaps suddenly spike. By what do I mean by them spiking is when the cost of insuring a product goes up 5 times, it is usually a cause of concern. Think of it this way. If you have your house and you're insuring your house, if today you're paying $200 a month and suddenly next month you need to be paying $1,000 a month, usually that's only going to be happening if you are in a scenario where either there was a flood, either there was a hurricane, there was a catastrophe somewhere around your place, which has now made it in a highly risky scenario, and hence the rates of insurance have picked up. In the AI scene, when Oracle comes out and says, okay, we're going to do a $300 billion deal, and you do go out and see stocks like Oracle making these moves, literally, if you go down and look at this, when they had the OpenAI deal, you went directly all the way from here, which is about $243 per share, all the way up to about $345 per share, and then moved lower. The reason to that is that the market somewhere decided that this is not something that they're ready to risk for Oracle. Oracle, obviously, second, third richest guy, maybe after the Google current run up that you've seen, you are going to see Larry Page come in as second and Larry Ellison come in as the third. He's a great friend of Donald Trump. Again, everything that I'm saying is not financial advice, so don't listen to me. What do I know? But, anyways, more importantly, please focus on this fact that just because everyone screams AI doesn't mean that you are going to see stocks go up another 5x, 10x. Remember, the bull market began, as much as people don't want to agree to it or want to agree to it, it began post October of 2022. We are in the third year of a bull market. The first 2 years of a bull market are usually very strong. In the third year of a bull market, you usually are necessarily green, but not as strong as the first 2 years. We are entering a midterm election year next year, November. Like I've said before, the period from November 1st, 2026 to 2 quarters after the midterm elections, which would be somewhere around June of 2027, are usually the most bullish periods in a 4 year presidency. The period between January to November preceding the November midterm elections are usually painful. They can average from anywhere from a negative 19% to a positive 6%. Now, if I tell you a positive 6%, most people are going to be like, oh, that's a good number. But here's the story. You've been having positive 20% years in 2023 and 2024. 2025 has been a positive year, double digit as well. But when I tell you 6%, imagine what's going to happen to stocks that are of high beta. Let me give you a simple example. Look at a stock like Reddit. When you go down there and you look at a simple stock like Reddit, you can look at the way it's been volatile. You're looking at, if I go down and look at a monthly chart here, you're looking at anywhere from April lows where it was already pretty much down and out at sub $80 levels. Today trading at 218. Last week was down to 171. 3 weeks, three months back actually was at 281. So please remember, if you're trading or investing in high beta stocks, be safe out there. This reason I'm making this video, it's not going to be a very long video like we usually used to have, but this is more of a video to try telling you that it is important that when you have made a bunch of money or have unrealized profits, realize some of that profits. Take profits from time to time, especially if there is strength in the market. It's very important. This is a very important thing that I want everyone to remember, is sell when you can, not when you have to. It's very important that you must be cognizant that yes, everyone around on CNBC, on Bloomberg, everyone could be screaming that this pullback will now make a new high. Yes, maybe it does. Maybe we do go to 7,000 on the index. It's quite likely we might, with the way we've seen the past 2 or 3 days. Do not forget that on Thursday, when the index literally came lower, you were looking at a fall just because of Nvidia's earnings. Now, I'm going to show you some of these charts. Have a look at it. You have seen the index come all the way from 26,202. And if you go down and look at this chart from 26,202, we were down about 9%. That's the largest pullback that the market has seen since May Liberation Day levels. We're back down now only about 4%. We're going to take about 4.96% that you see here to recover back. Can we do that? Maybe. And I'm not saying it's not going to happen, or it can happen, cannot happen. Look at the S&P 500, looks better. About 2.5% to go and make an all-time high. Quite possible. Remember, the leaders of the previous bull market necessarily also need to continue. This is not something that looks like it is now going to be a leader. Nvidia is now down closer to 17 to 18% from what I can see here. They're down about 17%. Now, a lot of Nvidia's fall has to also do with the fact that Google's chips might be used by Meta, and hence Nvidia is going to see a windfall of about negative $180 billion in revenue that they otherwise would have got from Meta. Is that a good sign, a bad sign? It's a great sign for the AI story in general. But remember, a lot of the euphoria has been built around by OpenAI, by Nvidia. A lot of these guys doing circular financing, a lot of these guys doing a lot of investments within each other. It is not a cause of concern, yes, because these are cash rich companies. They are making a lot of money. All of this is tied to the consumer, which no one for some reason is talking about, which is why I want to talk about this. Hence, I'm making this video because I want to tell everyone that, guys, the US economy is not as strong as you think it is. Is the AI economy strong? Yes, 100%. Are the AI companies that are making all this money and spending all this money strong? Yes, they have all of that. Nvidia accounts for 8 to 9% of the Nasdaq, or more maybe. At least 6% of the S&P 500 the last I checked. Keep in mind, as Nvidia keeps growing, if you do not see the share price recover, these are signs of topping out. These are signs of exhaustion. You can get smaller run companies going up 8, 9, 10%. You will see your portfolio go up. If you sell, you will think, oh, I missed out on this, I missed out on that. Remember, stocks can fall like crazy. Let me give you a simple example. Look at a buy now, pay later company like a firm, right? Phenomenally well run, maybe by far some of the best management you can ever look for. Remember one thing, but when I'm saying they're one of the best managements, they were the same management when they were trading at $180 a share. Impeccable management. It's the same management that was trading at $8 a share. So You can have great management. Everything depends on the consumer. This stock had a fall directly of about 95% in 2022 when the Fed was hiking. Granted, the Fed currently is not hiking, is currently cutting rates, so that is conducive to higher stock prices for high beta stocks. You have seen the stock go up almost 600%. But it is not unlikely that if the consumer weakens, this stock can be down here another 60%, down to 22, 23. And I'm not calling doomsday, but what I'm trying to say is that when you see strength in your portfolio, when you see things improve, make sure you take profits from time to time. You are no more in the start of a bull market, we're very well into a bull market. You as well as me and nobody knows when this ends. So it is important to build cash from time to time to act in case the drops come through. In case you see some of these high beta stocks come down 30-35%, it is not abnormal for them to be doing that, but you need to be able to act, which is why I say you sell when you can, not when you have to. And you will feel really stupid for having sold if the market continues rallying and it keeps going up. But remember that it is better that you sometimes reduce risk. And I have been one of the most bullish people for the past 2.5, 3 years. At some stage today, I do believe that the consumer is weakening in America. Yes, you did get a number that came in of about 119,000 new jobs in non-farm payroll. That was September data. August and July, they've been revised lower into negative. ADP that comes and gives us weekly data. They've been coming out and telling us that we've been losing about 2,500 jobs on average. As of yesterday, we got to know that now we're using about 13,000 jobs, losing 13,000 jobs. The unemployment rate has ticked up from 4.1% all the way to 4.4. If you go into the numbers and look into the second decimal place, it is 4.44. If not for a 0.01% increase or decrease on the unemployment rate, we would have been at a 4.5% unemployment rate. The current market rally that you're seeing is happened since Friday is because now there is an 80% chance that the Fed is going to be cutting rates in December, post Fed Williams giving a speech on Friday saying he is looking at that it is appropriate to have a near term reduction in interest rates. I'm of the opinion that irrespective of what the Fed does, 25 basis points is not cutting it out for the US consumer today. The consumer is weakening. You have negative payroll numbers. Yes, September was positive. That is just a single month, plus can be revised, usually revised lower from the trend that we're seeing. Unemployment is at its high in the past 4 years. We're close to hitting the number that the Fed itself has been saying of hitting 4.5%. So maybe on December 9th, 10th, when the Fed meets, you are going to be getting a 25 basis point cut. But do not expect him to be coming out and being dovish by saying, look for more cuts. It looks likely that there are more cuts. He is going to be hawkish. He is going to come out and say that it does look like the market is weakening, the unemployment rate is ticking up, jobs are becoming an issue. At the same time, guys, yesterday you did get inflation numbers from PPI, which was sticky. They are higher. Remember, the Fed has a dual mandate. They need to keep prices lower as well as unemployment steady. They cannot have one of them play around this way where one goes out of whack. At this moment in 2022, when you go around and think, you were able to see that interest rates did go higher purely because of the fact that inflation was very high. So you had to bring it down, and that was the cause of concern at that moment. Unemployment was not an issue. The weighing scale has completely turned. Unemployment is an issue. Now, one of the most important things that I want to talk to you guys about before I end this is that in April, when you had a fall and the market collapsed, all of that could be turned by a single tweet. A single truth social post by Donald Trump could come out and say, okay, guys, tariffs are off. And that's what we did, right? And we're back to square one, markets rally 10%, and things go on. The US China trade deal is completed. There is no more good news coming from there. The Fed at this moment cannot provide us with any good news because they don't know what's going on. The government shut down, no data, all of that. Considering they are a data dependent Fed, they have no data. And when they have no data, they're not going to be able to know, how do I move ahead? If the Fed doesn't know what they're going to do, there is going to be obviously no good news coming out of them, if not bad news, at least. Donald Trump has already signed his trade deals with everyone. China is already done. So there is no great news coming out from there. The unemployment rate is ticking up and the consumer is weakening. Yes, you might get seasonality working for you when it comes to being bullish, because you will see Black Friday sales, Cyber Monday sales. Maybe they're higher than last year. Remember, they're also going to be higher than last year because you have an inflation ticking up. So as people buy the same product, which is a higher price, it is a more amount of dollars spent. And as more amount of dollars are spent, you are going to start seeing that trickle down into higher numbers for Black Friday. So keep in mind that is important as well. The unemployment rate among young individuals, college grads, is pretty much at its all-time high, or has been as high as it is since 2008. I'm not sure about that, but it is relatively higher and maybe touching double digits. These are signs of concern. It is important that you realize that in this whole game that you're trying to play of making money when it comes to stock markets, you must be prudent. It is okay to lose the last 10-15%, but not okay to lose 50. Because when it starts falling, you will not be able to sell, because you will keep thinking this is a pullback, and it could keep dropping. And by the time you actually sell, you'll be down 50%, which will take you back a year, 2 years in where your numbers were. So stay prudent. This is just a video that I'm trying to make to open people's eyes to the concept that maybe we're not in an AI bubble, but the consumer is weakening. The economy is not running at the pace that it was. And at the end of the day, companies like Meta, companies like Google, companies like Apple, all of them, these guys make a lot of money purely because their consumer pays them. If the consumer weakens and their numbers drop, even from a 22% growth rate to a 21% growth rate, the market is not going to allow them to spend that much on their capex. If they spend less on their capex, their stock prices are now going to start turning down, because now it's going to be a scenario saying, oh, is the economy weaker or should we spend on AI capex? What is more important, right? Just out there, please remember, sell when you can, not when you have to. Don't sell if you don't need the money, but stay vigilant of what's currently going on. I will most likely come back next week, hopefully even towards the weekend, if anything crazy happens, with another video, and let's take it from there. Anyways, thank you so much, guys. Have a great Thanksgiving. Enjoy yourselves. Thanks.